You can build $1 million real estate portfolio without ever showing a tax return. No income docs, no W-2s, no DTI limits. Sounds illegal? Well, it's not. It's called a DSCR loan. And it's how investors scale when banks say no. Hi, I'm Jonathan Wells. And in this video, I'm going to show you exactly how a DSCR loan works, why they become the go-to tool for both small and large investors, and how you can use them to keep buying properties when others get stuck. So, if you're serious about qualifying for your next property, fill out the free questionnaire linked below, and you'll see just how ready you really are. It's quick, it's free, and it tells you what your next move should be. Now, let's talk about the problem. Most investors hit a wall. You buy 1 or 2 rentals, you write off all your expenses, and suddenly, your tax returns make it look like you don't make any money. Then your banker sees that and says, sorry, you don't qualify. But you and I both know the truth. Your properties, they do make money. They just don't fit inside the traditional lending box. Now that is where DSCR loans flip the script. And here's the fun part. In the next few minutes, I'll show you the exact numbers lenders look at, how much you can borrow, and what kinds of properties qualify. So stay with me, because this is the loan that helps investors grow faster than ever before. Now, the DSCR loan stands for Debt Service Coverage Ratio, and it measures one thing: does the property pay for itself? So here's how it works. You take the rent that the home brings in every month, let's say $2,000, and now you divide that by your total payment, your mortgage, taxes, insurance, HOA dues. And if that comes out to $1,600, your DSCR rate is 1.25%. That means that the property earns about 25% more than it costs to own. And that's really what lenders care about. Not your job, not your income, just can the property carry its own weight? And if it can, congrats, you qualify. And if you want to follow along, download my free DSCR calculator below. You can plug in your own numbers and see if your next deal meets the ratio. Now, before I tell you the 4 different types of DSCR programs, here's why this matters. Most investors stop buying when their personal income runs out. They think they can't qualify. But the truth is, if your property makes money, you can keep going. And that's why these loans exist, to let cash flow qualify instead of you. So let's break down the 4 main DSCR programs that you can use in 2025. Number 1, DSCR Supreme. This one is for the top tier borrowers. We're talking things like strong credit, simple types of properties, low risk. It's perfect for the experienced investor who wants the best pricing. Number 2, you have your standard investor DSCR. This is classic. It's flexible, it's forgiving, and it works for standard 1 to 4 unit rentals. No income docs needed, just property cash flow and credit. Number 3, you have DSCR no ratio. This one's powerful. So even if your rent doesn't fully cover the payment, you can still qualify based on credit and reserves. That means you can buy in an appreciating market where cash flow lags behind the value of the home. And number 4, you have DSCR multi and mixed. This expands your option up to 8 units mixed use or 10 units residential. This is a great stepping stone for investors who are ready to scale past single family homes. Now, if this is making sense so far, please hit that like button and subscribe for more strategies like this. Every week, I drop a new video that breaks down real estate mortgage tactics used by top investors. Now, here's where things get really interesting. Let's talk about how lenders actually qualify the property. For purchases, the homes can be vacant. Lenders just use the appraiser's rent schedule. It's called the 1007 or the 1025 form to estimate market rents. For refinances, it should be leased unless it's a short-term rental or a rehab ready to list. Now, there's one rule you can't bend. You cannot live in the property, and neither can your family. This is strictly for investment use only. Lenders will also cap your total exposure. Usually it's 10 loans or $10 million in total. If you're doing a no ratio deal, the limit's about $7.5 million with up to $5 million in a cash out. By the way, if you want a full 2025 DSCR guideline breakdown, it's inside my free investor guide below. You can grab it right now. It includes things like LTV limits, credit scores, and reserve charts straight from our new matrix. Now, let's talk about the fun stuff. Short-term rentals. Think Airbnbs, VRBO, beach condos. These are some of the most profitable DSCR opportunities right now. The program defines short-term rentals as nightly, weekly, or seasonal stays. The key number here is a DSCR ratio of 1.15 with a max loan to value of 75%. To qualify, you'll need proof that your area allows short-term rentals and an independent income validation report. You can get both of those from Property Guard, VRBO, or your AMC's short-term rental analysis. That means that you don't need a full year of booking history. You can use projected income to still qualify for today's house. And if you're thinking about buying a short-term rental, download my short-term rental prep sheet below. It lists every document you'll need to get approved faster. Now, let's zoom out and look at your loan's structure. DSCR loans aren't cookie cutter, and you can pick what fits into your strategy. We have things like the traditional 30-year fixed, sometimes even a 40-year fixed, or an adjustable option like a 5.6 or 7.6 ARM tied to the 30-day SOFR rate. And yes, you can do interest only for up to 10 years, which gives you more monthly cash flow today, which also means more capital for your next deal. If you go interest only and it saves you about $400 a month, that's nearly $5,000 a year that you could stack towards your next down payment. And I actually built a simple cash flow growth tracker that shows you how much faster you can scale when you reinvest that money. So grab that sheet below too. It's also a game changer. Now, let's talk risk. A DSCR loan isn't a no rules loan. You still need good credit, you still need reserves. A 700 credit score is ideal, but some programs will let you go as low as the mid sixes. You'll also want 6 to 12 months of reserves, especially if you own multiple properties. And remember, no ratio loans usually have slightly higher rates and lower loan to values. That is the trade-off for flexibility. The investors who win with DSCR loans are the ones who keep strong liquidity and show rental experience. That's how you get the best pricing and build real estate leverage over time. Now, let's bring it home. The big picture, DSCR loans are the bridge between the small investor and the portfolio builder. They let you grow without waiting for your W-2 to catch up. They let you scale even when your tax returns say zero income. They give you freedom to keep buying, and that's what builds wealth. So don't wait for rates to drop. Use the tools that already exist to move forward now. Down below, you'll find every resource I mentioned: the DSCR investor guide, property cash flow calculator, the short-term rental prep sheet, and the cash flow growth tracker. And if you're ready to build your next 12-month acquisition plan, book a free 15-minute consult with myself or someone from my team. We'll show you exactly how to structure your portfolio using these loans. And listen, if you liked this video, you'll love the next one. I'll see you there.